Ladies and gentlemen, good day and welcome to Elin Electronics Q3 FY23 results conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Venkatesh from Axis Capital Limited. Thank you, and over to you, sir.
Yeah, thanks, Vivian. Hi, everyone. On behalf of Axis Capital, we are very happy to welcome you all today on Elin Electronics Limited's Q3 FY23 earnings call. From the management side, we have with us Mr. Kamal Sethia, Managing Director, Mr. Sanjeev Sethia, Director EMS, Mr. Akash Sethia, Head Strategy, Mr. R.K. Chhajjar, Chief Financial Officer. I now hand over to Mr. Kamal Sethia for his opening remarks. Thanks, and over to you, Mr. Sethia.
Thank you very much, Venkatesh. Good evening, ladies and gentlemen. This is Kamal Sethia, and we also have on call today our Director Sanjeev Sethia, Akash Sethia, Head of Strategy, and CFO R.K. Chhajjar. Thank you very much for joining our first earnings call for the quarter ended December 22. Coming to overall performance for the third quarter, which is historically the softest quarter for us, and further as the demand across our industry was also subpar, our consolidated revenue for the quarter ended 31st December 22 was rupees 2023 million against rupees 2585 million in the same period last year. That's a degrowth of 22%. Consolidated EBITDA for the quarter was rupees 133 million against rupees 162 million in the same period last year, a degrowth of 18%. Consolidated PAT for the quarter was 46 million against rupees 69 million in the same period last year, and a degrowth of 33%. We are happy to share that post our IPO, we are now a debt-free company with net cash of rupees 860 million. Given that the IPO happened only recently, full benefit of reduction in finance cost will be seen in the next fiscal. Our capex in Q3 was 127 million, which comprised of approximately rupees 50 million in 33 kVA line for uninterrupted power supply and lower tariffs, plus rupees 50 million in plant and machinery and balance towards space creation. Our working capital cycle for Q3 23 was net 59 days against 66 days in Q3 22. Now I will share with you the performance and the strategy in each of our businesses going forward. In lighting, fans and switches segment, the revenue for the quarter was rupees 753 million against rupees 921 million, representing a year-on-year degrowth of 19%. This was primarily driven by reduction of 47% year-on-year in revenue of fan segment for rupees 140 million to rupees 75 million due to introduction of new energy efficiency norms by Government of India with effect from 1st January 23. We understand that the inventory of old fans, that is non-starred fan, has largely cleared out and channel stocking of energy-rated fans has begun. Due to the subdued market, new launches of BLDC and TPW fans, that is table pedestal wall fans, were delayed from Q4 FY23 to Q1 FY24. Lighting, including flashlights, also saw a reduction of 100 million from rupees 740 million to rupees 640 million. However, going forward with introduction of street lights and increased quantity of battens, this segment is poised for gradual growth. In the small appliances segment, revenue reduced from 400 million to rupees 313 million. This was primarily driven by mixer grinder, where revenue fell from rupees 162 million to just 47 million. Irons were also down from 141 million to 119 million, a drop of around marginal drop. Sale of personal care products, however, that is hair dryer, hair straighteners and trimmers, were up from 78 million to 128 million rupees. This should get further fillip from trimmer, where full-scale production has begun in Q4 FY23. To arrest this decline of sale of mixer grinder and hand blender, we have taken a strategic decision to assemble motor-related appliances such as mixer grinders and hand blenders at our Ghaziabad facility, where motors are being made currently, and which these appliances till now were assembled in Baddi. This should result in cost savings, especially on packing and freight of motors which are manufactured in Ghaziabad and then sent to Baddi to be manufactured into a finished product. We have also turned our attention to the ODM aspect on appliances with the hire of a new development head for design. We expect to launch ODM models of irons and mixer grinders in 2 to 3 quarters from now. Additionally, we expect to launch a range of new products with electric sterilizers, heated hairbrush, kettles, etc. over the course of each of the next 4 quarters. In FHP motor segment, revenue were down from 609 to 360 million, primarily driven by reduction in sale of mixer grinder motors from rupees 470 million to 260 million. The decision of moving assembly of mixer grinder and hand blender from Baddi to Ghaziabad should help increase in captive consumption of motors as well. Sale of fan motors were down from 101 million to 57 million only due to changes in government regulation explained earlier. We are entering the air conditioning market with supply of outdoor unit motors. We also expect that sale of chimneys and therefore chimney motors should increase post increase of custom duty on chimneys from 7.5 to 15% in the budget. We are also in the initial stage of evaluating motors for electric vehicles for 2 and 3 wheelers. Overall, Q3 FY23 has been a challenging quarter for us. We understand from our customers that overall market sentiment was down, resulting in low sales due to unfavorable macro environment amidst rising interest costs. For an average middle class customer, interest rate on home loans have gone up from 6.5 to 9% per annum in 1 year, resulting in increase in EMIs and consequent decline in discretionary income, which has a direct impact on consumer durables and appliances sales. However, we believe that this aberration to be temporary and that this should correct itself in a couple of quarters or so. While things are looking up, we expect Q4 to be better than Q3, but still muted compared to last year. We continue to make investment in our business and have high conviction in it. I think I'll pause here, and me and my team are there to take up the questions from everybody. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Participants who wish to ask a question may kindly press star 1 on your touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Kindly press star 1 to ask a question. first question is from the line of Sandeep Tulsian from JM Financial. Kindly proceed.
Yeah, very good evening, everyone. Thank you for taking the question. First question is, Kamalji, if you could guide us now with this sudden weakness that we have seen in the demand in third quarter, and you are indicating that the same is likely to sustain in fourth quarter as well. Where should our annual revenue numbers be for the full year, and what kind of margins should we end the current year with at EBITDA level?
Okay. I'll just put on Akash on this, and he will answer this question.
Sandeep, so I think given the current scenario, we will probably end this year at about the same revenue as last year. We will be flattish, year on year. As regards, EBITDA margins, while the continues to maintain the same level of margin. However, given the some of the investments that we are doing, there may be a slight dip in the absolute rupee EBITDA year on year. Does that answer your question?
Yeah, understood. So margins may be a little lower year on year. So where we ended at around 10.3 last year, they should be lower by a couple of bits over there.
It should be in and around. Like I said, the core business will definitely enjoy approximately 7%. But like I mentioned, because of some of the other investments that we are doing, for example, I'll just give an example. Like we are migrating to SAP, our software system. We are migrating to SAP now. That is a one-time revenue kind of expense, which may kind of impact our profitability one time this year. One time I wouldn't pay kind of too much attention to that. Like I mentioned, the core business continues to enjoy a healthy level of profitability.
Got it. So how much would that one time such SAP and other investments totally contribute to?
It is probably a little bit too early to just quantify that, but maybe we can just connect offline. I will just kind of just get the totality of these one-offs, and happy to connect offline.
Sure. And same outlook, if you can also share, Akash, for next financial year, this FY24, what are our revenue growth targets and where do we expect our margins to head out to?
So on the margin front, we remain fairly confident that we will definitely be north of 7% EBITDA. We should be in and around the 7.5% kind of mark. This is for FY24. And in terms, we expect a growth of at least 30% in FY24 in terms of revenue.
Regarding the segments, Akash, I have a couple of more questions. Firstly, on, of course, a very detailed explanation was regarding each of these segments. But within small appliances, what was the primary reason for such a sharp decline in mixer and grinders? Is it because of products not being as price competitive, we lost share to some other companies, which is why we are moving production from Delhi to Ghaziabad? Or is it because of any other reason that you could highlight where the market share of the brands to whom we sell is going down, or generally we have declined in line with market? So can you give a bit more color on that or more granularity on that?
Sure. I'll take up that question. I'm Kamal Sethia. It was basically we have been in touch with all our customers. We have quite a few number of customers for mixer grinders, and most of these leading customers, they were in them supply our motors to a lot of mixer grinder manufacturers who are sourcing motors from us. Even their revenue was cut down on mixer grinders specifically in December quarter. It's very difficult to pinpoint the main reason for reduction in that sale. People were skeptical that probably as the star rating is coming into fans, it might also come into mixer grinder. So that was a kind of a pushing, the sales down. But I don't have any pinpointed reason of reduction in that. These are the the feedbacks I'm getting from customer on low sales.
No, Kamalji, the question was to ask whether we are in line with the market decline, or if you could, say how much was the volume because of price decline, because the numbers that you shared indicate such a sharp decline that mixer grinder sales have almost become 1/3 of what we did. So if you could break down to price, volume, and probably how much you would have declined according to the industry growth rate in your sense.
Yeah, so I would made 89,000 mixer grinders in last year, October to December. Against this, we could make only 25,000 or 25,500 pieces in last December quarter 22. So it was a significant decline in that. As I said, it was very difficult to pinpoint any particular reason on reduction on sale of mixer grinder. What to my mind comes is that probably people were also thinking that maybe the star rating in mixer, that's why they postponed their sales. So it was a sharp decline, but it was across industry segment. As I said, like a lot of mixer grinder manufacturers buy motors from us, even their sales saw almost 50 to 70% decline in offtake of motors, as well as for us, a complete mixer grinder also saw that kind of a decline. So it's difficult for me to pinpoint any particular reason, and even our customers, we have been trying to take feedback. They could not update on what are the reasons. Competition, the prices, we have been doing mixer grinders for the last 15, 20 years. Price is never a challenge. But to optimize our operations, we thought of moving it from their infrastructure there, and we could save on packing and freight costs. That much advantage we can pass on to the customer if we are able to increase sales. So that is the primary reason of transferring it from Baddi to Ghaziabad.
Understood. And one last question from my side is on the fans, where because of the EU norms, we understand the sales were muted for last 2 quarters. Around in the last 1.5 months since these new norms have come in, what is the current run rate? Have you normalized sales to where we were prior to these norms coming into effect, and the inventory channel stocking stopped when it stopped? Has it normalized, or you're still how far away maybe to normalize the next quarter? Please guide on that. And also similarly on the mixer grinder post end of 3Q, have we recovered? Has the market recovered? If you could give more outlook on the demand per se, and essentially just trying to figure out where this 30% growth next year will come from. That's about it. Thank you.
Sure. So on mixer grinder front, I will speak. It is that the traction is back. The orders are flowing in. Pipelines are almost dry. So that's why we see a traction in January and February, and this quarter we should be able to get, because all our customers are now giving us orders for mixer grinders as well as motors. So we feel that yes, the worst is over for mixer grinder, and now it is gaining traction. And for the other segment, I will request Sanjeev, because he looks after that business, to come in and explain the reason for that. Yeah, Sanjeev.
Hi, this is Sanjeev. So with respect to fans, yes, the demand is back. So we are seeing healthy orders right from January onwards for both the star-rated fans and other categories of fans like the pressure fans. Another category of fan which is going to be the big growth driver for us is the TPW category. Like Kamalji had earlier mentioned, that because of this lull in the demand of overall the fan business, that launches got pushed up by about 2 months. So we expect that in category also should start, and that will further give us a boost in that growth, and we'll be back in terms of the forecast was for the fan business. So yeah, fan is back to the expected volumes.
Understood. Thank you so much.
Thank you, Sandeep.
Thank you. Participants, if you wish to ask a question, kindly press star 1. Participants are requested to please press star 1 to ask a question. We have a follow-up question from the line of Sandeep Tulsian from JM Financial. Kindly proceed.
Yeah, hi, sir. I thought I'd just take a couple of more follow-up on this. One is also, we have shared a detailed launch timeline of multiple products over the next 4 quarters. If you could give us an indication, what is the kind of additional top line that we are looking at from all of these products combined in FY24? And since, the launch is going to happen in a staggered manner, what is the full potential of all of these new products in FY25 as well?
Sure. I'll just share Akash to update on this.
Sure. Thank you, Sandeep, for your question. So, we have, various products across categories that we are launching, like you rightly pointed out, at various different points in time, over the next few quarters. If I were to give you a broad sense of the aggregate revenue potential of these new products for the next fiscal, which is fiscal 24, conservatively speaking, we should be in and around the 200 crore kind of mark. 200 crore rupees from all of the new products that we've indicated for fiscal 24.
And for 25, how much can we ramp up to?
I don't want to, kind of make that assessment today. The reason is that, for a new product, typically on a certain ramp timeline, all of that. So I'm just giving a very conservative number for 24. Probably, we will be able to update the correct number for 25 for the new products in a couple of quarters from now, once we see how, the market is kind of taking it.
Got it. Second thing also is on the PLI part. We had applied for a license under the white goods category. Where are we in terms of starting production under this incentive scheme? And what kind of revenue build-up should happen under PLI? And will we book anything in FY23? Are we eligible, or how much should happen from FY24 on the PLI side?
Yeah. So Sanjeev looks after this lighting business. Can you update on that, Sanjeev, on PLI?
Yeah. So as far as PLI is concerned, lighting is the business where we qualify for as of now. Probably the AC ODU motors could be another going forward. So currently we have made some investments in the lighting business with respect to the PLI scheme. And overall, if you see the lighting business, there's some growth. About we'll be growing at 6-7%, or maybe a slightly more than that, let's say, as compared to last year. So I don't expect, the PLI to have a very significant contribution on the overall revenue for, let's say, this fiscal. But next fiscal, now with some of our new products, like we've invested for, like the street lights and some of the connected lights, I see you touching about around at least 20% plus, which will give us, the accrued benefit, because the PLI is on incremental sales, it's not on the total sales.
Understood. And one last point over there was on this export that we want to start for one of our largest LED light customers, where they're looking to increase the sourcing from India. Where are we in terms of time? What are we doing when we're waiting for this 20% growth next year in lighting the export numbers as well?
Yeah, Sanjeev, can you answer that on export of lighting?
Yes, I will. So basically, there were two product categories where we had mentioned that there is a potential to export. One is in the solar street light category, which we see, of course, the end product is exported here, but unfortunately, it's not a direct export from us. I mean, it's through Signify. So there we are already seeing a healthy increase as compared to last year. The solar street lights have picked up. And just to give you a number, let's say we were doing an average about 300, 400 numbers of solar street light per month. That has gone up to about 1,500 pieces a month. So we already see a healthy increase there. And these are pretty high value products. They're all 20,000 rupee north kind of products. The second category where we had pretty high, we have a high expectation. One was the downlight category, where we said that Signify is looking to, as part of China Plus One strategy, to source low-cost lighting out of India. Exports, we were exporting this directly to Signify Sri Lanka. Unfortunately, situation in Sri Lanka had deteriorated drastically, and that export had come down. We are seeing that things are picking up again, and we expect, of course, those exports to start again. B, our discussions with respect to, moving some of the products from China are ongoing. What we find is that some of these products which were designed and developed for India were specific to maybe India or the neighboring countries. They were not meeting some of the more requirements in terms of UL and other certifications which maybe Europe or US would require. So Signify is in the process of tweaking some of their requirements or some of the product design. And so that's an ongoing discussion, not concluded yet, but hopefully very soon, we should be able to start this process of, becoming an alternate major supplier for downlights.
Sure, Sanjay. So I might add that in principle they have decided to source it from India. Of course, the tweaking has to be done to suit the European and US requirements, which we are in the process of doing it. So quite hopeful on that front. Yeah. Thank you.
Understood. All right. Thank you so much.
Thank you. Participants, if you wish to ask a question, please press star 1. To ask a question, you may press star 1 on your touch-tone telephone. The next question is from the line of Venkatesh from Axis Capital. Kindly proceed.
Yeah. So I had just a couple of questions. The first one is, obviously the third quarter revenues have been disappointing. I think from your own perspective also. So firstly, I would like to understand, when did you actually realize that the quarter was actually not turning out the way it was? Was it like, from right from October and November itself, the slowdown had started, or is this something which suddenly started slowing down in the month of December? So if you could highlight, that would be very useful.
Sure. See, the customers, they share a forecast to us, and they have been very bullish about it, that yes, whatever the forecast is there, they will beat, and they kept on pushing us to supply that, keep the material ready to be supplied, in anticipation that during the Diwali sale and festival season sale, they will, deplete their inventories lying with them. But somehow that inventory did not deplete, so we kept the material ready with us. So it was kind of a surprise to us in the end only, and every day the discussions were on. So we were not aware of it. We only came to know that yes, the sales are sluggish. But, always the customer was pushing us that you keep the material ready, we'll lift it up. Don't worry on that. But somehow that did not happen. So we kept our production lines active to meet the demand of the customer, but the demand did not come up. So it was not we knew it in October, November or December that the sale is going to decline. We were hopeful that whatever slowdown was there, customers would move their inventory from their godowns and they will pick up from us. So that was the reason. But it was ongoing process, and somehow it did not materialize that they could move their inventory from their warehouse in time, which was very unpredictable. And in like in my 30, 40 years of history, this kind of a situation never has arisen. So we have been hopeful that yes, it will catch up, but somehow it did not catch up.
Okay. So as a follow-up, now at the end of third quarter, you must have have a pile-up of inventory of finished goods. Is that the case?
Sure. So basically, we are very particular about our inventories and our debtors, so we keep a good tight control on that. So for whatever we were doing, we were keeping the material ready for, let's say, we work on a 2 to 3 days inventory. When that gets depleted, then we are producing other material, which is in a day or two we can meet the customer's requirement. We keep the material ready at our suppliers' end, so they can supply in 1 or 2 days' time if the demand is required. So as you will see from the data we have uploaded, we have kept our inventory in control. We have kept our debtors in control. Akash will share the numbers.
Venkatesh, if I can just give you some sense on, the days inventory, that will probably, kind of clear your clear question. So at 31st December, we had about 52 days worth of inventory. This is 31st December 2022. The corresponding number in 31st December 2021 would be approximately 40 days of inventory. So as you can see, in 12 odd days, inventory pile-up was there.
Okay. No, it was not like from a negative sense. I'm wondering how this whole cycle happens, in the sense that a client tells you, let's say before the third quarter, the client tells you that, okay, I am expecting a very good festival season. So these are what I'm planning to sell. So you please make this and keep. So wouldn't you already make and keep, or is it like, you can turn it around in like 2 days and make it and send it to him? See, because I'm surprised if the sales is disappointing for the third quarter, you've also not manufactured also because you felt that it will be weak. Like, I can't understand what is the turnaround time between they telling that I need the product and you manufacturing and giving it to them.
Okay. As a policy, we keep 3 days inventory in our factories, product inventory. Rest all inventory is work in progress or with our suppliers end. We can turn it around in 3 days because there are multiple customers and multiple products. So that's why the policy of 3 days is kept, so sudden orders can be met. But then within 3 days, if the customer gives us a demand, so we can make it in 1 day or 2 days and supply and meet their demand. So that is not a challenge for us. That's why see, if I start to make the entire requirement of a month together and keep it in the factory, that would have hit us very badly. So our suppliers are all long-term old suppliers. They cooperate with us, and then our factory is also tuned in such a way that within 3 days we can meet the demand. We can convert from raw material to finished products and supply to our customers. So that's why we keep a minimum inventory in our factory. Our normal inventory for domestic products doesn't go more than 7 to 8 days. So import, of course, we have to keep a bigger inventory. But in our process, let's say 90% of the material is locally sourced, only 10% imports are there. So that's why we can manage our inventories in a proper way.
Okay. My second question has 2 parts. Now, first of all, this year you have said that your number will be similar to last year, which is around 1100 crores approximately. Now, post that you are expecting like 30% growth for FY24. So that comes to like 1430 crores or so approximately. Now, so the first part of the question, is it possible to share your thought process, the breakup of that 1430 crores, which are the sub-segment wise where you are going to get how much? So that would be useful. A. Second part is, most of the consumer electrical companies say that over the last year and a half, they've all increased prices by 12 to 15% or so. So there is a sticker shock, whatever, that the retail inflation is too much. So for example, if you see all the B2C companies, they have struggled to grow even 5%. So why do you think this will change next year? In the sense that the high prices are still there next year. the high interest rates will be there next year also. The EMI will be high next year also. So is it not possible that next year also, you might have a downside risk to this 30% kind of growth? Because 30% growth is a very large growth. So what is allowing you to grow faster? Is it like new product lines are coming in or new geographies are coming in? If you could throw some light.
Sure. See, there are two aspects to it. First, of course, the existing business, how it is growing, and second is the new products which we are launching. So I see out of the 30%, 16 to 17% sales are coming from the new products which were to be launched in, let's say, quarter 3 or quarter 4. Now they have moved to quarter 1 next year. So that kind of a sale we expect from the new product launches. All these products are import substitute products which customers were importing, so they have some orders in pipeline, so ramp up time is there. But then this almost 16 to 17% is coming from the new product, and rest of it is coming from our existing product category. In the last quarter, some raw material prices were getting moderated. We had passed on 3 to 4% reduction also on most of our products to our customers because of the commodity prices moderation. So that, of course, is, we don't see much of a problem there, that in the coming year, of course, with the current inflation, as the January and February markets are picking up, so we don't see a challenge there that we will not be able to meet the next year's target. And the targets what we have made is kind of a realistically conservative market, conservative forecast projections we are doing. So that we don't see much challenge there. Yeah.
Okay. Now, as a follow-up, you mentioned there were a few products which were supposed to be launched in the quarter, which has got now postponed to the next year. If you could just highlight what are those products which are supposed to be launched, which got postponed, and why it got postponed?
Yeah. So first and foremost, let's talk about TPW fan. TPW fan was supposed to be launched in last quarter, in December quarter, but the markets were so bad, and the customers were waiting and watching the movement of their existing inventory. So in the downtrend market, people tend to not launch their new products. They want to launch the new products when it is markets are moderate. So TPW fan is a big business for us going forward, and these were all imported products, and we have got a very good support from our customers localize it, which we have successfully done, and it has already started. The trial productions and mass productions have started. Full traction will come from Q1 next year. Another product, let's say, was BLDC. BLDC fan again were put on a back burner because of markets were so low. Now it has already started picking up, almost 200 to 300% growth we see in BLDC going forward. That is the kind of orders we have already received from our customers. So these are the two categories which were delayed on the launch. Everything was ready, and in the low slowdown in the market, people tend to delay the launch. Third category, I would say, is the ODM product what we are manufacturing. For that, we have already started the tooling. Normal cycle for a ODM product from concept to launch is around 4 to 5 months. So that at least 4 or 5 models of appliances, our tooling has been loaded, and those toolings which have been loaded, they are unique kind of product, not in our existing range. So we see that is an additional market we are going to get, and most of these products are import substitute. Customers were importing, now they have thought of localizing it. Example again, next product can be chimneys. Now the duties have gone up, so now there is a big thrust from all our customers to fast track the development of chimneys, which we are also geared up and doing it. So we're going to see a new thrust in demand for chimneys because we already make chimney motors in-house. Now it's a matter of making complete chimney. These are all high-value products which are going to drive our projections for the next year. So we are quite hopeful on that. And going forward, definitely we see a lot of new customers getting added to us, for these categories what we are launching.
Yeah. Actually, I had a couple of more questions. One is, this quarter you did something like 200 crores kind of revenues. I mean, what exactly was your plan at the beginning of the quarter? Was it more like 250 crores, 300 crores? I just want to get an idea how much was the scale of the disappointment in this quarter for you?
Sure. Akash, can you take it up?
So Venkatesh, I think at the start of the quarter, what was in the pipeline was probably around the 275 crore mark. Obviously, when I say 275, it's a plus minus 5% kind of variation. So against that, we've been, we are at about close to 200. So it's almost about 35 odd percent.
Okay. And last question from my side. Now, when I see your numbers for 3 quarters, your gross profit margin, which is, raw material less the revenues less raw material cost and inventories, if I adjust all those things, it seems like your gross profit margins have been slowly inching up. So what exactly is driving this gross profit margin improving?
So that is a function predominantly one of sales mix improving, and two, like I said, typically, the raw material price reduction, the benefit of it comes to us with a slight lag, in some cases on a monthly basis, in some cases on a quarterly basis. But it's probably a mix of the two of those two. One is, improving sales mix. Two is, like I said, softening of commodity prices.
Okay. One more, if I could ask one more. I mean, on a steady state basis, what kind of EBITDA margins is possible? We will remain in the 7 to 8% kind of a band. Am I correct?
Absolutely. That is the number that you should work with. Midpoint of that. So we typically work with 7.5 kind of EBITDA margins on a steady state.
Okay. And ROC, it will be around 10-11% pre-tax, right? 11%.
No, so ROC, if you look at it pre-IPO, it was actually close to 16 odd percent. It is only post the IPO, because what has happened is that the equity base has expanded now. So that money needs to be put into use, so invested, and thereon returns will kind of start flowing. So in the interim period, probably for a year or so, ROCs will optically look a little bit lower. But if you look at a ROC number on, say, for example, the first half number or last year's number, they were still north of 15% on a pre-tax basis.
Okay. That is all from me. All the very best.
Thank you.
Thank you. Participants who wish to ask a question, kindly press star 1. As a reminder to participants, kindly press star 1 on your touchtone telephone to ask a question. Participants, you may press star 1 to ask a question. Venkatesh, there are no further questions in the queue presently.
I think we can close if there are no questions.
Thank you. I now hand the conference over to the management for closing comments.
Okay. Thank you so much. Yeah.
Okay.
Thank you.
Yeah.
On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us. You may now disconnect your line.